Hi, good afternoon to my lovely madam and also to my group members. I'm Sangeeta here. We'll be giving an introduction on audit of long-term payables and comprehensive income. According to that, Michelle will be giving the processes involved. Then Davy will be giving the internal control. Grace will be giving the inherent risk. Then I will be giving audit objective. Then the last is Nitya will be giving audit procedures. Okay, now I'll be giving the introduction. First of all, audit of long-term payables is about the auditors must assure that the amounts shown on the balance sheet for the various types of long-term debt and not materially misstated, which is common types of long-term debts, financing, include notes, bonds and mortgages. Then, for the audit of comprehensive income, which is mainly for expenses, the auditor must be satisfied that the expense is not materially misstated and approved by accounting standard, which is MFRS. Then, the audit of expense accounts depends on the extent of work, which is NEP, nature, extent and also timing. Conducted on the entities control system and also balance sheet accounts. That's all from me. I will pass to Mishan about process.
Hi, my name is Mishan and I'm going to present about the process involved in the audit cycle for the audit long-term payable. Okay, there are 3 steps we can see. The first step will be review the board of directors meeting minutes. Okay, the auditor have to make sure that any new loan agreement or bond issuance are authorized for the year, which is the auditors have to check if there are any loan they have had, like that. Okay. The second step will be look at the client agreement, which is the auditor have to check out the loan documents and have to check which is there are any important terms for they have had for the loan agreement, and also they have to check the notes of the principal, rate and the length of the loans also. Okay, the third step will be examine cash transaction, which is trace any cash distribution made for the clients, and also check the customer's invoice and check the debts transaction. Okay, in this case, we have to see in the expenses also. In the expenses, they had the same method but in a different way, which is the auditor have to check the any of the transaction which the company had made or the client had made. And the second thing which is they have to check they have any terms or conditions like that. For example, if they had if they had purchases motor vehicle, something like that, and there will be had a agreement which will had which we can see that there are terms of the depreciation of the percentage or the loan that have to pay for the monthly. And the last thing there is they have to check whether it's the motor vehicle has exits or not. They have to check for it. And also if the motor vehicle has been confirmed, so it's considered that they have expenses on it, and also they will be approved by the auditor. Thank you from me. So I'm going to pass to Dave.
My name is Devi. I would like to talk about the internal control involved. Long-term liability. Long-term liability should be properly authorized by the board of the direction by a negative majority of the shareholders. There should be proper control over issue and unusual obligation in a bond. Redeem bond should be cancelled properly, multiply and reference for audit in order to prevent. Bond ledgers should be used in which detail of the bond issue, cancel and outstanding should substitute. Procedure in ledger should also be maintained by the issuing corporations. Proper control should be exercised on the payment of the interest on long-term liabilities. The expenses company have many types of internal control related to expenses. Some invoice may require certain level of signature and other may require redundant contract. One of the first steps in audit is the evaluation pay expenses. Again, how closely they follow the internal control. An offshoot of the step is the auditor to be reclaim changes should be find lawlessness with the control that may allow an employee to abuse or misuse the process of the paying expenses. Example of expenses is salary expenses, supplier expenses, office supplier expenses, and depreciation expenses, and other supplier expenses. I pass to Grace.
Hi, my name is Grace, and I'll be talking about the inherent risk. So what is inherent risk? Inherent risk is a risk posted by an error or an omission in a financial statement due to a factor other than a failure of internal control. In financial audit, inherent risk is most likely to occur when transactions are complex or in a situation that require a high degree of judgment in regard to financial estimation. What is inherent risk? When we take an example in financial statement, when we can see an example, let's take an example of expenses. Inherent risk of expenses is the susceptibility of expenses account to misstatement. It is related to the nature of complex of the expenses account. In the audit of expenses, the primary inherent risk is the understatement of expenses, which is related to complete assertion. Next. Okay, so this inherent risk mostly normally assessed as a low moderate bonus because the volume of transactions are low. The accounting is not complete, and also the final reason is because the entity often receives third-party statements. However, the amount are often large and the financial market have developed and complex instruments and have characteristics of both debt and equity. The inherent risk with relation to this instrument is normally high. Okay, however, the amounts are often large as the financial market have developed sophisticatedly and complex instruments that have character of both debt and equity. The inherent risk is relation to this instrument is normally high. I will pass it to Sangeeta.
Hi, I will be explaining about audit objectives. First of all, there is two parts for the audit objective. First is account balance level. For the long-term payables is, first one is existence, which is the first objective an auditor will review is to make sure the long-term liability exists or not. To assess the existence, an auditor will view the double-check liabilities and also call the other party to ensure that obligation exists or not. The second one, rights and obligations. The next step is to ensure the long-term liability belongs to the business or not. Using the relevant paperwork obtained during the test for existence, the auditor will check to ensure that the business owes the money from the liability. The auditor will also check to ensure that an appropriate agent of the business approved the transaction and that the proper process was followed or not. Then, the third one is completeness. The entity should maintain detailed records of long-term debt transactions to ensure that all borrowings and repayments or the bonds of principal and interest are recorded. The debt amount recorded in the subsidiary ledger should be reconciled to the general ledger control account regularly. Then the last is valuation. Finally, an auditor would check the liabilities are recorded at the appropriate values as defined by generally accepted accounting, which is GAAP short form. For example, note and bond transactions are recorded in the accounting records at their face value plus or minus any premium or discount. Premium or discount should be amount using the effective interest method to calculate interest expenses. Then the second part is transaction balance level for the long-term payables. First is accuracy, which is the amount of long-term liability to be recorded appropriately and related to disclosures have been appropriately measured and described. For example, prepare an account analysis for long-term debt, discounts, premium, and related interest account. For example, should recalculate the amount of long-term debts also. Second one is occurrence. Sufficient documentation needs to verify that the note or a bond, which is about liability, was properly occurred or not. For example, the long-term debt must be genuine and also occurred as well. So auditor should make sure that long-term debt is supported by official receipt that's signed and make sure that it is not a dummy one. Then the third one is completeness. The auditor need to check the long-term debt for a year is completed, none is left not recorded. If did not achieve this objective, the long-term debt will be understated and also make sure that the receipt is pre-numbered and follow the sequence to ensure no missing incomplete long-term payables. Then the classification. Do determine all the notes and bonds are properly classified in financial statements. The common issue is to properly classify as a short-term liability and the portion of long-term debt is due in the next year. Then the last one is cut-off. Auditor should make sure that all long-term payables in only for 1 year. For example, all the long-term payables only for 2019 and it is not included in the next year, which is 2020. This is to make sure that the long-term payables only accounted for January to December in 2019. So this is not compliance with MFRS, which is MFRS stated that cannot record next year payables in current year sales or long-term payables. Okay, the second one is about income statement for account balance level. This is similar about to long-term payables also. For existence, the objective for existence is about the expenses balances appearing on a company's income statement exists as stated at the end of accounting period that the income statement covers or not. The objective for existence applies to all expenses included in the income statement. The second is completeness. The objective for completeness is about the income statements are detailed and include every item that should be included in the statement for a given accounting period. The objective of completeness also states that a company's entire expenses, even expenses that may be temporarily in the possession of a third party, is included in the total expenses figure appearing on an income statement. Then only we can achieve the completeness. Then the third one is right and obligation. It's same as a long-term payable also. This is to ensure the expenses belong to the business using the relevant paperwork obtained during the test for existence. The auditor will check to ensure the business owes the money from the expenses or not. The auditor will also check to ensure that an appropriate agent of the business approved the transaction and that proper process was followed. The last one is valuation. Finally, an auditor would check the expenses are recorded at the appropriate values as defined by GAAP. For example, general expenses recorded in the accounting records at their face value plus or minus any prepayment and also accrued expenses. Then the transaction balance level for income statement is first is accuracy. Auditor will ask invoice from client and test to make sure that each expense accurate or not. The way to state it is accurate or not is should recalculate the expenses, which is price times quantity. This is to make sure that the expenses amount is to be correct and accurate. The second is completeness. The auditor need to check expenses for a year is completed, none is left not recorded. If did not achieve this objective, the expenses will be understated and make sure that the receipt is pre-numbered and follow the sequence to ensure that no missing and incomplete expenses transaction. Third is occurrence. The auditor should make sure that the expenses of 10,000 are really occurred and the transaction must remain. So the auditor should make sure that expenses are supported by invoice and that is not the fake one. Then cut off. Auditor should make sure that all expenses is only for 1 year. For example, all expenses for 2019 is not included in 2020. This is to make sure that expenses only accounted for January to December in 2019, which is followed by the MFRS. Then the last one is classification. The auditor must make sure that all expenses recorded according to MFRS. There are sequences that client purposely credit expenses, debit sale. This is to manipulate the account to show the profit low or less. This is from me. I will pass to Nitya about procedure.
Hi, my name is Nitya Shireen. I'll be talking about audit procedures. So, audit procedures for long-term payables are carried out to obtain a schedule of all activities related to share capital for the current period. Example, whether the total number of shares issued as per the balance sheet agrees with the total as per the share registered. And also to verify the amount of authorized share capital against the Memorandum of Association and also Article of Association. And also, it is to recompute the share premium credited during the year. For example, examine the Board of Directors minutes to ensure that any issuance or redemption of shares during the year has been approved by the Board of Directors. So, the audit procedures involve test of control, substantive test, and also analytical procedures. The types of audit procedures is physical examination, confirmation, documentation, analytical procedure, inquiries of client, checking re-performance, observation, inspecting, and other actions. Okay, so a test control is an audit procedure to test the effectiveness of a control used by a client entity to prevent or detect material misstatement. Depending on the result, these tests, the auditors may choose to rely upon the client system control as per of their auditing activities. If the test reveals the control are weak, the auditor will enhance their use of substantive testing, which usually increase the cost of an audit. For example, examine cash transactions. The last place an auditor look when reviewing their client's long-term payables is cash transactions. They should trace any large disbursements made by their client or cash receipts hitting its bank statement to the appropriate source documents, because the company may be trying to artificially inflate sales by recording a loan as sales revenue. The source document in this case would be the customer's invoice. Analytical procedures are one of many financial audit processes which help an auditor understand the client's business and changes in the business and to identify potential risk areas to plan other audit procedures. For example, reviewing the Board of Directors meeting minutes. During their review, they should make sure any new loan agreements or bond issuance are authorized. This varies client by client. But normally, auditors look for a motion and vote to approve taking on new debts. Okay, that's all from me. Thank you.
Okay, this is about a real case study happened by Able Construction Company and will be explaining by Grace, Nitya, and also Mishan.
Hi, I'm Grace. The real case study that we have chosen is Able Construction. Able Construction Company entered into long-term construction contracts, recognizing income using the percentage of completion method of accounting. To finance its operation, Able borrowed funds from the bank and agreed to comply with restrictive loan covenant dependent on reported income from the long-term contracts. The percentage of completion method of accounting requires, among other things, an agreement with well-defined, affordable terms, a reliable method of estimating costs to compile the contracts, and recognize the loss at the time they have become known. As a part of the audit of Able, the auditors read the contracts for all the projects in process, tested costs incurred to date, and assess the ultimate profitability of the contracts, including discussing them with the management. In fact, Able had incurred a significant loss on one of the major projects. Able engaged a subcontractor to do reconstruction work not to anticipate on the original contract bid. In awarding the subcontract, Able entered into an agreement with the subcontract that the work would not be paid for until after its auditor was completed. In an effort to defer recording losses associated with the additional work, management hid the subcontractors' invoices from the auditors as they were received. The fraudulence mistaken was discovered several years later when Able went bankrupt and the CPA firm was used by the bank for re-performing indicate audits. The firm was ultimately found not responsible, but only after spending extensive time and a large amount of money defending its audit. And I will pass it to Nitya.
Okay, the key problems committed by Able will be engaged a subcontractor to do reconstructive work not stated in the original contract agreement, hid the subcontractor's invoice from the auditor, and also recognized the loss but doctored the invoices. Able went bankrupt and the CPA firm was sued by the bank for performing inadequate audits. I'll pass it to Mishan.
Thank you. Okay, I'm going to explain about the solution. The solution will be the auditor need to do the test of control for the internal control system. For example, the auditor need to examine the payment voucher to ensure that the payment were duly approved by the officer. Second, observe whether there are segregation of duties between the function of authorization of cash payment, handling of physical cash, and recording transaction. Third, the auditor have to examine evidence to approval for the written off of bad debts. And lastly, they have to check the bank reconciliation statement which they are prepared. Thank you.
Okay, thank you, Thomas.
Okay, thank you.
Thank you.